GM. Weekend Warriors. Weekend Workshop. Let's go. All right. G fucking M. How are we all? With the Weekend Workshop intro, which is fucking GM. All right. How is everyone? Grinding on the weekend? So, is this Weekend Workshop in the room with us right now? This is G. Stealing. Stolen. GM. Okay. Today, we've got a very special one. We have trade management. Hotly requested. Who said? What do you mean OG music? I don't get it. You mean that music's good? Or you want old music? I don't get it. Anyway. G fucking M. So. Where is my guy? I got a special delivery. Where the fuck's my special delivery? 1 second. Okay, I'm back. Special delivery. In tow as well. Time for some ASMR. Listen to this. Who can guess what it is? Let's fucking go. Alright, so today we're going to go through trade management. If you have not been on one of these streams yet, GM, and trade management, this is Weekend Workshop, so it's only up for 24 hours. And if you've got a question, put the question in the live questions once I open it, but the question must be specific to today's stream. Alright, so it must be to do with trade management. So the way we do this is I go first through like a mini lesson, and then I take questions after. All right? Good. Let's fucking go. Okay. GM. Let's get right into it. Trade management. Let's fucking go. Okay, first of all, what is trade management? It is everything you do from the moment you open a trade to the moment it's fully closed. Okay? The entire process is known as trade management. Now there's two ways to do it. There's one, which is the way you do it in boot camp when you start out and you build your systems. You get a system, and you get some rules, and you say, okay, I go long here, my stop loss goes here, my target goes here, and I just wait. So you set it all up, you enter the trade, and boom, you wait. Either it wins or it loses. That's like the simplest form of trade management. And simple, as you all know, if you've been here in my campus for any length of time, you'll know I love simplicity. Making stuff any more complex than it needs to be is not a good idea. But, of course, if you trade for the next 20, 30, 40 years and you take hundreds or thousands of trades, you will not just open and close every single trade using your fixed rules, stop loss, take profit, and entry. There will come times where things happen. And you can improve a system by adding things like early invalidation, by taking profit at different areas, by moving your stops, etc., etc., etc. You can absolutely improve a system with that. But you must not Treat trade management as a discretionary thing, which is like, I'm going to open a trade and then I'm going to see how it goes. And I'm going to react on the fly. And once I see weakness, I'll close it. You can't leave it so vague. You're just setting yourself up for failure if you do that. So, systematic, rules-based trading is king. Now, what I showed a second ago where you just entry, stop loss, take profit, the most simple form of trading, that is systematic, rules-based trading. But it is not breaking that in any way to include trade management techniques. Moving your stops is still systematic and rules-based. Compounding a trade is still systematic and rules-based. Having multiple take profits is still systematic and rules-based, and so on. Now, it can very easily not be systematic, and it can very easily break rules, and that's what I'm going to talk about avoiding. Because emotions are a big part of trading, and basically you have no emotion before you enter a trade, at least I would hope so, and you have lots of emotions once you're in a trade, because you've got skin in the game, right? Money's on the line. Suddenly it matters more. And so think about it this way. If the time at which you have the least emotions is the time where you're going to make the best decisions, that's just verified fact. When there's less pressure and there's nothing clouding your judgment, you're going to make better decisions. If you're planning a trade and you plan it out and you plan a long trade if it goes to this level, you plan a short trade if it goes to this level, you can be objective and say, okay, I've got an idea for long, I've got an idea for short. They both follow my systems. Cool. Once you enter, let's say the long comes up first. Even the best trader in the world, once they enter that long, guess what? They're now bullish biased. They now want it to win, of course. They want it to go up. So some level of objectivity gets removed. Let's say before you enter a trade, you're 100% objective, right? Meaning you can equally see reasons for it to go up, reasons for it to go down. You have no bias. Then as soon as you enter that trade, if you enter a long, for example, even the best trader on planet Earth, they might drop to 95, 96, 97, 98% objective. But every single person loses that 100% objectivity once they're in a trade. And of course, then it's a scale. If you're a brand new trader, your objectivity might go from 100% to 10. Right? It might just completely send you crazy once you're in that trade and you desperately want it to win. So what you should imagine yourself is, over time, as you trade, as you follow rules, as you compound, as you build your systems, you want to move yourself more and more and more towards that 100%. And just imagine you start at 10%. You're trying to get yourself to 20 and 30 and 40 and so on. So proper trade management does not in any way contradict systematic rules-based trading. It actually reinforces it. The way you do this, 5 steps. Number 1, build objective systems. So that is like what I showed. Right? Build an objective system, entry, stop loss, take profit. Backtest it, obviously, to figure out does it have plus EV. Then take it live, get into dollar trading. And then observe those results. So trade it. Actually trade it live for a time. And as you gather data, observe those results. Observe potential areas where you could improve. Look at your winners. Look at your losers. Could you have got more out of your winners? Right? Do your trades have a pattern where they actually go quite a bit beyond, especially when they're a winning trade, they go quite a bit beyond where your initial take profit is? If so, and when I say patterns, really important to just stop at the moment and say, if you take one trade, right? Let's say you take one trade, like this, and it goes up, and it goes to your take profit, and then fucking boom, it goes way, 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 way up. Don't look at that and think, oh, my take profit's wrong. It's only if there's a pattern across a large enough series of trades. So let's say you do your 100 back tests, and you notice you've got 40 winners, right, in your 100 back tests, and you notice that on 10 of those winners, price went significantly beyond the original TP without going anywhere near your entry again. So it does this, it continues trend. 10 out of 40 is 25%. So 25% of all your winners could have extended further. That might be something where you want to go back and observe, retest with new rules to see, what if I didn't take profit here, or what if I took half profit here, half profit somewhere else, and retest those rules. But again, at this point, it's equally important to say, remember what I just said? 10 out of 40 do this. That means the other 30 don't. So that might mean that 30 of them go like that. And if that's the case, then leaving your trades open because 10 of them went higher might actually be negative, because it could lead to you losing some of your losers. Your win rate might drop. Your expectancy therefore might drop. So it's always a constant process of testing and refining. Observe the results, identify improvements, test those improvements. Take your first system, put it to the side, don't get rid of it. That's system 1A. If you change something, let's say you want to add 2 take profits instead of 1, so you want to take 50% profit at the first take profit and 50% at the next level, go and retest another 100 or however many, 50 at minimum, I would say, with those new rules, so you can see, does this actually improve in backtesting? Does this actually improve the system expectancy? Because yes, sometimes it's going to work. But if the sometimes that it works don't outweigh the times where it fails, it's better to just leave your simple system as it was. Plus, you're having less complexity by doing that. Remember, any extra decision you add increases complexity. So if you're going to increase complexity from 1 take profit to 2 take profits, which doesn't sound like much, but it's a lot of extra complexity. It's doubling it. It's an extra decision. It's 100% more decisions about your take profit. That's a lot. You want to make sure that it's noticeably better. Not just like, oh, well, the expected value, if you're a white belt, you might not know this term yet. You will when you get to blue belt, don't worry. The expected value of this system, with my 3 rules, entry, stop loss, take profit, was 0.5. And then I added in a 2 take profit rule, right, where I take 50% TP here, I put 50% TP higher. That improved the system to 0.51. That is probably not worth doing. It very marginally increases the expectancy while adding complexity. That's not a good idea. Because it means you have to be in a trade for longer, right? By definition, if you take half profit instead of full profit and you leave some open, you're still in a trade. So that's more minutes or hours or days, depending on your trading length. That's more minutes or hours or days where you have to sit and watch an open trade, watch the P&L, get all those emotions, have all those possibilities to make a bad decision. A lot of trading is just about stopping you. You're trying to save yourself from yourself. So make sure that if it's going to be extra complexity, there has to be extra expectancy. Significantly more. Obviously, so you test those improvements and then add them to the system if suitable. All right. Next. Ways to improve performance through trade management. There's more than this, but I think this is plenty for anybody to get started with. And this is the big 5. This covers pretty much all you need to know. There's always exceptions, but if you can, master these, you'll be flying. By the way, I'll kind of stop here. This is probably like a purple belt and beyond thing to do. So if you're at white belt, if you're at blue belt, this and you're on this stream, you can learn a lot from it. Take your notes, note it down, learn from it, but don't feel a pressure to implement any of this at this stage. The way I would actually directly advise you guys is, if you're white belt, don't put any of this into action yet. In white belt, just focus on white belt. That's always the case at white belt. Don't worry, it's not long until you be blue belt. You can be blue belt within 30 days, or 31 days technically, right? It's not a long time. And if it takes you longer, that's fine. If you're blue belt, I think it's okay to apply all of this in backtesting, but not live, right? So, which means if you want to then take your systems and go back and redo them with moving stops, moving take profit, compounding, early invalidation, managing order types, all of that. Order types is live, so do all this stuff in backtesting and don't feel a real need to implement this stuff live yet. As you develop through blue belt, let's say you're getting well on towards your 100 trades in blue belt, your live trades. Let's say you've built a few systems and you're getting the hang of it. You're not purple belt yet, but you're on the way, well on the way. Start to introduce some of it, that's fine. And then a purple belt, you should be applying this. Yeah. You should be starting to look at this. How can I manage trades live? Because it's a good skill to learn. Even if you're not going to end up being somebody who manages trades very actively, it's still a good thing to learn. And the way you can learn that as well, by the way, is with dollar trading, like low stakes trading to begin with. Even if you're purple belt, and because in theory, in general, purple belts and beyond have gone past the dollar trading stage, but it does not mean that you stop dollar trading. dollar trading is just low stakes. It's not using your full size, it's using small size. Because you're trying to get used to the execution. You're not worried about making loads of money. Because remember, you're testing these things. You don't know for sure if this compounding is going to work or if it's going to make things worse. So start off with low stakes. Do a few weeks of low stakes with whatever you're trying before you then size it up. So the ways you can improve performance through trade management. Number 1, moving your stops. Number 2, compounding. Number 3, multiple take profits. Number 4, early invalidation. Number 5, reducing fees. Moving your stops. Classic. Right? That's where you enter a trade like this. Your stop loss is here initially. Okay? And as the trade moves in your favor, let's say the market goes up like this, you move your stop up in line with rules. The reason for that would be if the market starts to pull back, you get stopped out, but you get stopped out in profit because you've identified an area that if it goes to there, it's actually more likely to go right back down. You're trying to identify essentially an early reversal or a highly probable reversal. Okay? Next, compounding. Compounding is where you increase your position size. You add to a trade. You do not increase the risk. If your initial risk on a trade is $10 and then you add to the trade, it goes in your favor. Classic way of looking at this would be like this. Okay, so your first entry is there and it trends. We'll just use a trend because trends are really simple to understand. Okay, your first trade is here and your stop loss goes there and your target is wherever. And then you see the market go up and break structure again in your favor. So breaks out here. You enter that. You move your stop and you continue in the trade. Oh, what have I done here? Okay, give me 1 sec. Get this right. There we go. What you're doing here is you're opening a second trade. So whatever trade you opened here, you open more, so you've got a bigger position. But when you do that, you must move the first invalidation up as well. So your first stop loss also goes up to where the second one is. And that's actually going to have the effect of moving your first trade into profit. Right? And then you keep the total risk for the overall trade fixed. Having multiple take profits, right? That's more simple. That's just like having 2 areas where you take profit. Maybe your first take profit area is there, right? And your second take profit off the exact same trade. So same trade, same entry, same stop. You just take profit a second time. So in this example, you would take 50% profit here, 50% profit here. And you just leave the trade as it is. Number 4, early invalidation. That's where you see, you essentially use a lower time frame generally or some other indicator or measure or metric to identify when is a trade likely to fail. Okay, when a trade might be likely to fail. Let's say your original trade is like this, okay, and it goes up, and it goes up, and it goes up, but it then does that, and does that, and does that. Your initial entry is there, your stop loss is there, your take profit, let's say, is higher, right? So it reaches towards your take profit, but it doesn't quite get there. What you're trying to do is identify something like this market structure break, that when you see it, you say, okay, because of this, my testing tells me it's more likely now to reverse and go all the way back to my entry or even to my stop loss. So instead of hanging on for my original TP, I'm going to go down, I'm going to close it, and I'm going to close it in profit at the invalidation. That's early invalidation. And number 5, you can improve your performance through better trade management of your orders by reducing fees. One of the biggest hurdles a trader has to overcome is the fees. Every time you use an exchange and you enter or exit a trade, you're going to pay a fee. You can do that through limit orders or market orders. Market orders are more expensive, and I'll talk about that in a second of how you can reduce that. So, how do we actually do it? Well, I'm going to show you. I'm going to show you two of my own trades that had trade management involved. One of them is from yesterday. For anyone who's on the live trading stream, you would have seen part of this. And the other one, so it's a day trade. And the other one is a swing trade from several months ago. So let's look at that. All right, first of all, yesterday we had a trade which was over here, and it was during it was a news event based trade, and it was after the non-farm payroll data came out, and we had this spike, and then price went up. Initially I went long, and then I closed the long and I went short. So we'll break all of that down and explain the different elements that were involved in this live trade. This live trade incorporated early invalidation. It incorporated moving stops. It incorporated multiple take profits. And it incorporated moving take profits as well. Or having no fixed TP. Which means having no fixed take profit means you don't know when you enter where you're going to exit, because maybe you're waiting for something like a market structure break, right? You go long and you don't know if you're going to exit it at 57,000 or not. You don't know if it's going to be a 57.2. You're waiting for this to happen, right? Your market structure break. You're long, you then close it. Right? So you don't know when that's going to be. Therefore, you don't have a fixed take profit. You should always have a fixed stop loss. When you enter your trade, you should always have a level on the chart where you say, if this is wrong here, no matter what. There's no, oh, well, if it does this, I will close it. That's an early reason to exit. That's not the same as an invalidation. It's not the same as a stop loss. A stop loss must go in when you enter the trade. Because there has to be somewhere on the chart where you say, this idea is wrong. Now, the exact trade I used, which was explained on that stream, involved a bracket, which is how I trade news events. I wait for 20 minutes, so these are 5-minute candles. You have the data candle, the release. You have the next one, and next one, and then I use that one as a bracket. What a bracket is I draw around from top to bottom on that candle, and I use that as my trade entry point. So the rule I have for that is as soon as it goes above or below, I long or I short. And there's a maximum of 2 trades. One long, one short in any given data day. So the first thing I did, as soon as it went above here, if you remember on the stream, is I went long. And my stop loss went there. And I had no fixed TP because my take profit on these trades is when I see a sign of reversal, okay, based on my own systems, which usually is based on market structure and the bands as well, the EMA bands, these. So what we do here is I enter it based on 5-minute, so 5-minute bracket, 5-minute entry, 5-minute stop loss, but then I manage it on a 1-minute. And I'm managing on the 1 minute because what I'm looking for are signs of reversal. If you remember as we were trading this, my signs of reversal were a structure break and the bands going red. So over here, we had structure breaks there, right? Structure broke, but the bands did not go red. So we stayed in the trade. It went further up. Then it started to come back. Then it moved down. And after this candle closed here, this biggest red candle, that was my early invalidation. That was my reason to exit. Because in fact, we should probably watch it as if it's live. My rule to exit here was this. So I already was looking at several things. I was already looking at the fact that we'd moved above these highs and came back below. We'd moved above these highs and come back below. So the market tried to break out twice and failed. So there's already signs that this may be running out of momentum to the upside. If the bands are green, that's still fine. As soon as the bands go red, along with another break, which is here. So as soon as it closes below that level and the bands go red, that is when I want to exit. And that happened with that candle. I waited for that candle to close and then I closed my trade. So instead of taking a 1 hour loss over here, I closed it at that point, which ended up being a 0.46 hour loss. So in that way, I was able to protect my capital and not take a full loss on the trade. Now, it's not about avoiding the loss. That's a fear-based mindset. I wasn't doing it because, oh no, I don't want to lose money. I was doing it because, no, the chart is telling me, and my extensive data, I've traded data for years. Hundreds of times I've traded non-farm payrolls or CPI or PCE or GDP or FOMC, any of these like economic data or Fed meetings or whatever. I've traded them cumulatively hundreds of times. And I know from all my journal notes and all my past trades that if you see something like this on the lower time frames where it has a sign of reversal, it's more likely than not to go down to my stop at least, if not further. So that was a way to exit and to, in essence, save some money, for lack of a better term. So that's early invalidation. That's what an early invalidation looks like. Then, as the market continued, I had my second rule, which is I'm able to enter a short. And so I was able to enter a short once that level broke with the exact same method, which is the bracket. And that would be my take profit, or sorry, my stop loss. And so a couple of minutes later, that triggered here. Now we're in a short. Okay, invalidation goes there. At this point, the market continued in our favor almost immediately. And then we saw it move sideways into a compression, into a consolidation. At this point, roughly around here, it was just when I was about to end the stream, I was also, and this is, so one of the rules I have is, I was also going to be going away, like leaving the house for a couple hours after this, and not able to directly manage the trade. And there's actually another important level here, which I don't have that indicator, but this was the New York Open level, which is here. This was the New York Open, which is an important level for intraday trading. And we had that wick, if you see it here, we had that wick that touched it. So my initial stop at the bracket almost certainly would be fine, almost certainly. But I know that when I'm away, especially this, again, I've seen this many, many times. The path I was looking at that could happen was this. It would come down. It would take that level. It would take all the liquidity below this wick. And then it would have a strong squeeze up and then potentially go down further. That squeeze could very well reach my stop and just touch it off. It should not have gone above the New York Open if that level is going to be defended. So I took 20% profit down here. So I closed part of my trade. So that is a partial take profit. That's one of the rules we talked about as well. I took 20% off. The reason I took 20% is because I was going to move my stop loss. So I moved my stop up. And if I didn't take profit, that means I'm now risking more. I'm not risking 1R at this point. I'm risking like 1.2 or 1.3. So I took off a percentage of my trade so that if it went all the way up to the new stop, I still would have lost exactly 1R. That's risk management. At no point in a trade do I want to risk anything more than my original limit, which is 1R. Whether that's whatever, $10, $100, $1,000, $10,000, it doesn't matter. Think in terms of R, because you're going to be trading as you go through your career and your lifetime as a trader. Your size will change. It should. Hopefully, it's going to get bigger and bigger and bigger and bigger as your portfolio grows and you move from trading 10 to 100 to 1,000 and so on. The thing that will never change is R, how much risk you take in units versus how much reward you get when you're right. So that 1R is the most important thing. Of course, on each individual trade, that 1R will correspond to a dollar amount. Whether it's 10 or 50 or 43 or 152, it doesn't matter. But you must keep that fixed. So that was a multiple take profit example, and that was 20%. So I still have 80% open. So I still have two more, potentially one or two more times where I will take profit. That also shows an example of moving my stop. But that's actually moving my stop in the other direction. That's actually moving my stop further away. If I was going to move my stop down closer, which I'll show in a moment, I could do that too. As the market moved on, and when it broke down lower, and at this point I want to go to a 5-minute chart, back to my original time frame, to identify the structure. When I feel that the market has moved significantly lower, right, like here, for example, at this point, there's basically no way it should go to that stop loss point. If this trade is correct, remember what I was saying at the beginning? My initial expectation was that if it takes out this level, it could have a sharp squeeze up all the way there. Once it doesn't do that, it tried to go back inside, it came down, it went lower, and we had a candle close on the 5-minute at that point. I say, okay, that is now fine. I was obviously away from the house at this point. This is actually somewhere that I could consider compounding or just moving the invalidation. So at this point, moving the stop loss, which I'm going to just highlight with a red line, I would move my stop loss down in this example. Once I have some kind of idea of a structure level, right? You could use the bands in combination with market structure or whatever that might be. For me, a place to move it to would be to this level. You've got a gap that was left here. You've got a 5-minute high, and you could put it above there, right? But again, the specific rule for that is not as important because it's something that you're going to identify yourself and test for yourself. But once the market goes in your favor and breaks structure again, and is clearly now in a downtrend, you're able to move your stops. Generally, what you want to do is wait for something like this to happen, where you see a couple of structure levels happening. Like, even though, like, because on the way down there's no green candles, so it's a bit harder. Down here, now you've got a new swing high because price goes lower, and you've got another new swing high because price goes lower. So at this point, you could be trailing your stop, not using a trailing stop order. I mean, moving your stop. Trailing stops are something different. Down to there, right? I would put it above the wick, even though the invalidation's there. I'll put it above the wick, or down to here as it goes. This is if you're trading the momentum. The idea being, look, I don't care if it squeezes up. I want to get out of this trade if it starts to reverse. Because when it's gone very fast in one direction, it can also go very fast in the other direction if there is a strong enough squeeze. So you want to get taken out on that trade at that point. You don't want to leave it up to chance. You don't want to leave it up to interpretation. You don't want to leave it up to subjectivity. Just have your rules, fix them, and stick to them. Then this market continued further down. We went lower and lower and lower. And I'll show you where I ended up taking my next profit. Take profit. So we went on down, 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 down. And what I was looking at here was signs of the market slowing down to the downside. Kept waiting, kept waiting, kept waiting. Came all the way down to 53.395. We saw it go sideways, and it was there. Sorry, I'll go back. And go back to here. At this point, the market was slowing down, right? So it wasn't... Oh, shit. I've pressed the wrong button. Fucking... At this point, the downtrend was starting to slow. You can see this through the momentum. It was going down and down and down and down and down, and then it was going down, but they're false breakouts. Down, but it's false breakout. Right? So it's trying to reverse. At this point, also, again, this is where I zoom out and use my higher time frame levels. At this point, we also were coming into this previous low, which is a demand area on a daily chart. That was a previous daily low, which is very important, especially on something like a 5 minute. And you can see where that was, 53.345 on this chart. And so what I did for this trade was I took 50% profit at 53,300, which is just about there. Let me get it just in there. There we go. And on the next candle, you saw it wick down into it. There, not the next candle, but a couple of candles later. And there we see it. All right, so it hit that level there. I took some profit. I took an extra 50%, so 20% initially, and then of the 80% that was left, I took half of that off, and I left the rest on. This also was correlating with towards the end of the session, so this is more of like a day trading thing. But if I'm trading the New York session, it opens at 1:30 p.m. UTC. It closes at 8 p.m. UTC. So as we get to the end of the session, I'm looking for reasons to exit. Because the trade specifically for this style is within that session. I don't want to carry this any longer, especially on a Friday where you're going to carry it into a weekend. I want to take some profit because I know that other people are going to do that. When you get a strong trending move during a session, the expectation is that people will take profit, so shorts will take profit going into the close because they also don't want to hold it overnight or into the weekend, and that's how you can see the market rise, because taking profit causes the market to rise. When shorts take profit, it's buying pressure. So I then left the rest of that open and turned it into a swing trade. Now this is something that is separate in my systems. The way I want to describe this is, I mean, this is probably the most advanced part, is when to turn a day trade into a swing trade, or when to turn a swing trade into a longer term trade. You have to test this as well. So I know from experience that once we closed at 8 p.m, so we actually went lower, and by 8 p.m. UTC, we were right around here, right? And so Friday's session closed at the lows, which through all of my experience and testing shows it very likely sets up a bearish following week, which is why I've left some of that trade open. Because I know that over the weekend, we can do what we've done, right? We dipped a bit lower, but now we're kind of rising up, and you take it right to where we are now. The market is rising and it's sort of squeezing ever so slightly higher and higher and higher. That happens. That's very common. This is basically just a squeeze of anybody who didn't take profit over the weekend, right? Or didn't take profit, before the weekend. We see the market as it is right now. Just let it get to the present time. And here we are. All of this is just the painful grind higher for people who did not take profit at the end of Friday. I know that from experience and from my testing and from my data that it's quite likely that as we go towards Monday, this market will go back to the lows again and maybe even go lower. So I've left some of it open as a swing trade. Okay. All right, so that covered early invalidation, moving stops, multiple take profits, and having no fixed take profit, having take profits that are not fixed before the trade but have other reasons. Also, there is an advanced order type used there. So when we go back to this, advanced order types, you've got limit order, chase order, conditional stop. Limit orders are not advanced, but they can be used in that way. But in this trade, I want to go all the way back now and explain over here, right back from where I entered it, all the way over here. Take this off. Go back to this point. I'll show you how I enter the trades. So using the bracket, which forms here after the fourth candle, this bracket, as soon as this candle closes, I should actually go back. Okay. As soon as this candle closes here, and I have my bracket, it's very important that you get the orders placed quickly, because for my system and for my rules, as soon as it goes above there, I want to be in the trade. So I have to use a market order. But I'm not waiting for it to hit that level and then I manually enter a market order. What I use there is a conditional stop. So on your exchange, you will see it as conditional stop or just a stop order. If you place a stop buy order above the current price, so when the candle closed at 56,628, if you place a buy stop order at 56,662, that will go on the exchange and not trigger until price hits it. As soon as price hits it, it will trigger as a market order. And that's what I did, and that's how, as soon as this market moved up, it filled my order immediately. Okay. The exact same thing happened on the downside. So I had the stop loss placed here, which is just a standard SL. On your exchange, stop loss is just placed there. Okay. What it does here, on this second one, is I also use, so this was a conditional stop market buy on this one. Right, and so I'm going to put that in green as a buy order, not that you can even fucking see it, and it's a bit better here. I'm just going to actually take that off, right? And I, at this point, when my other trade gets stopped out, again, because it can move really fast, I don't want to wait around and have to enter it manually. I want to put in a conditional stop market sell order here. And so when the market came down into it, you see how fast it went down through it? I wanted my trade to just trigger immediately. It triggered. Then I put my stop loss in, just my regular SL in manually, and the market went on down. So that's using conditional stop market. When I exited the partial trade here, I used a limit chase order. Limit chase is a automatic order type on most exchanges and on terminals if you use a terminal. But it has it on most exchanges. I know Bybit has it just on the Bybit interface. And so when I went to take profit here, there's two ways you can take profit. You can just do a market buy order, right, for 20% to buy back some of the trade you had open, or which is going to incur more fees, because standard fees, that's where fees are. Standard fees, market order on Bybit is 0.055%, and a limit is, I think it's 0.02, isn't it? When you, as you trade more volume, your fee rates will drop. But at last I checked, the standard fees on Bybit are this. So you're paying almost 3 times as much in fees to use a market order as you are to use a limit order. So using a limit chase, the way a limit order works is if I wanted to exit here, I need the market to come down. Right? If I want to buy some to close my short, the market has to drop. But if the market's rising and it doesn't drop, my order won't fill. So if I had a limit order set here, let's go like back here, right? If I was like, okay, I want to exit some of this position, I could just use a market order and exit immediately, but I would pay higher fees. If I wanted to use a limit order, I could put it there, right? Which just ever so slightly, and I'll put it green because it's a buy order, ever so slightly below price, even just one tick. But then if the market moves up, not down, I have to then move the limit order up. I move the limit order up and move the limit order up as the market goes away from me. Instead of doing that manually, you can use what is known as a limit chase order. And using that, you can exit the trade manually. if you want to play around with this, you can use testnet, which is Bybit testnet. You can see, should be able to see, where are we? Here. Does not have it on, wait, here we go, chase limit order, there we go. Chase limit order, right? The chase limit order, you will place how much you want to exit. So 20% of it, let's say you had 3 Bitcoin short, you wanted to exit 20% of it, that would be 0.6 BTC. So you put in 0.6 and you would chase the order. And it would follow, so the system will manually, or sorry, not manually, the system will automatically move your limit order to follow price until it drops back and fills. Good one to look at. Again, more advanced, probably like purple belt stuff. Play around with it on testnet first if you're unsure of what it is. And of course, if you guys are unsure as well, ask in the chats. There's plenty of students using it. There'll be one of my masterclass students or a captain or a purple belt or somebody who can, answer questions for you as you're doing it. Or just ask me and ask Michael. We can answer those after. All right, so that's that. That's the first one. That's the first setup. Now, the second type that I want to look at is a swing trade example, which is from back in January of this year. And this was a 4-hour chart trade, I believe. And my trade was over here. And it was based off initially the 4-hour EMA bands. 4-hour Michael's EMA bands. And it's a system that I've tested for price consolidating inside the bands and then breaking above them with a BOS, which would be an entry trigger to trade it long, right? I also combine this with a under over. And the exact system rules here are not so important, so don't worry about that, but I'm just going to break it down anyway. On a 1-hour chart, you can see this more clearly. You have the high that led to the lowest low, then the market broke above it. So as soon as that close happens, you've got an early trend shift on the 1-hour chart. Then we had a double break where you had a 1-hour high that went to the lows and broke back above. So at this point, I actually started filling my trade, my orders. Now my initial trade was based on filling in here, and so I've been filling long orders with a stop loss down here. Reason being is that when you go back to the 4-hour and you see this compression, it should not go below that wick. Right? Definitely no way it should even go there, but initially my invalidation was at the 1-hour structure even below that. Right? The point of this trade though was to more talk about the compounding. So the place I compounded, so just imagine I'm already in a long. Okay, I'm in a long and my target, let's just say it's up into this supply up here. Don't worry too much about the target, again, not super important at this point. What I want to do is, if I'm right, I know that the market is going to move something like this. It's going to go up, and it's going to go up, and it's going to go up. So, at my original entry, if it goes in my favor, I can add to the trade and I can move my stop up, and move my stop up, and move my stop up. So you can get a bigger position on without increasing your risk. You're still keeping the risk constant, your original 1R. What you're doing there is you're risking losing the trade at a higher level, right? But your reward is a much greater return. And so how this works is, the first time that I would compound, right, would be as soon as we see a breakout. So this one is going to show compounding and moving stops. First of all, I move my stops up after we saw this, which was this breakout candle here. This breakout candle allowed me to move my stop loss up to here. At this point, I did not compound. I compounded as soon as the bands went green, which was here on the next candle, right? And so at that point, I added more to the trade. So I increased my position size by adding more here, and I moved my stop loss to the impulse candle low. This breakout candle here, I moved my stop loss to there for both parts of the trade. The way I would do this, I'll do the calculations just to I'll see if we can do the calculations. Okay. So, originally, I just want to keep it constant, right? Originally, the trade here had 1,000. Let's just say 1,000. Let's make it easy, right? See this here, 1,000? That means $1,000 price move will get me stopped out. Let's, for argument's sake, say I want to risk $1,000 in this trade. That's my 1R. So my 1R equals $1,000. That means I have to put on, and I'm going to exclude fees. Just bear with me. I'm not going to calculate fees. That means I'll put 1 BTC position size. Why? If you go long 1 Bitcoin and it drops 1,000 points, you'll lose $1,000. You will lose more because of fees. But for the purposes of example, let's keep it simple. So you understand now that this trade is open at 1 BTC. Okay? Here. So the size of this trade is 1 BTC. If it goes to that stop, I lose $1,000. I then get the breakout, and I get to move my stop up. So my stop is now moved to 552. Let's just put that to 500, just to make it simple. Okay. Now, if this trade loses now, at this point, I would only lose 500. So I have some wiggle room to actually add to the trade. And that was my second trigger. So once the bands went green, I was able to add to the trade. So I added here, and I moved my stop loss to there. So this is 1457. But my stop loss for the other trade goes right up to break even. So this trade cannot lose any money. It can go down and lose 0. So I have $1,000 that I can now risk again. Because if the first trade gets stopped out, I lose nothing. If I want to keep that 1R fixed, then I would take 1,400 and size Bitcoin appropriately for that. So that's going to be like 0.66. Let me just get my fucking thing here. 1457. Okay. 1457. Okay. That would be about 1457. 0.68. So I would add 0.68 BTC here. So if you imagine it as a second trade, my second trade is now open with 0.68 BTC. If that one loses, I lose 1,000 because 1457 times 0.68 equals 1,000. Okay? So the second trade would lose 1,000. The first trade would lose nothing. I would lose the gains, right? The unrealized profit. I would lose that, but I wouldn't lose any of my original risk. Now, you notice what's happened? I now have a bigger trade open. If I never touched it, I would have 1 BTC. So every dollar it goes up, I would make one Bitcoin times that. Every dollar it goes up, I make another dollar. Now, I've got a total of 1.68 BTC, which means every dollar it goes up, I make 1.68. So that's compounding. And the exact same logic applies all the way along. So as the trade continued towards my original take profit, which wasn't fixed, but was just around this area, as the trade continued towards my original take profit, I was able to compound this again because we happened to have a really nice, really nice setup. Okay, so the market consolidated in the bands, and I'm pretty sure it was this BOS over here. I can't exactly 100% remember, but I'm almost certain it was this break of structure here, where I was able to move and add to the position again after this BOS. Okay, then I was also able to move my stop. Because we have a new structure level, we have a swing low, we have a breakout. It's also respecting the bands. And if it was going to lose, and it goes to here, basically, if it goes like this, then the trade is wrong. So what we got to see here was another position getting added. Now at this point, there's a 1,089. Let's just make that 1,000. There's another $1,000 stop. I move this one up. Right, this stop now moves up to all the way up here, which actually puts that one into profit. But let's just call it roughly break even. So at this point, I've got 1.68 BTC open, but because I've moved my stop loss up, all the way up to here, I can't lose any money on the first two trades. So if it goes all the way back down and stops me out, I would lose 0. So I can add another $1,000 of risk. If it's $1,000 stop loss, that means I can add what? 1 BTC again. So now I add another 1 BTC. So now the total trade is still 1,000 risk if they all get stopped out, but the reward is going to be much greater because it's now 2.68 BTC. So every time it goes up $1, I make 2.68. That's compounding. Now again, the risk of this, if I just left my original trade, the risk is something like this happens. It drops down and then goes to the original target. If that happened, I would lose all these trades. I would lose $1,000, but the original trade wouldn't have lost anything. The original trader would have actually won. So compounding is not without risk. You are risking your unrealized gains. You know, there's no free lunch. You don't just get these easy fucking can't lose trades or whatever. So anyway, it goes along, and then breaks out higher. Okay, I ended up closing the trade in multiple parts over there. But let's just imagine, for the purpose of this, let's just imagine this trade closed there at the original take profit. So the first trade, which I now need to actually go back and kind of fix these because I need to make it more clear. The original trade was there. No, it was there, sorry. Right? So if I never touched the original trade, it was a 5.86R. So that would have made a 5.86R. Okay? 86R. That one. If I never touched it. Because I added to it, the total trade was 5.86 plus 0.68 times this 4451 times 4451. So that added another 3R. So this one added 3R more. And then the last one was 1 BTC at 3223. So that added another 3.2R. You can see this here. This one added 3.2R. And so the total at the end when this won was 5 plus, 6.2 plus 5.8. So about 12.06R. Right? So 5.86 plus 3 is 8.86, plus 3 is 11.86, plus 0.2 is 12.06R. So by compounding, I turned a 5.86R trade into, into a 12R trade. That's the purpose of compounding. That's a perfect, in air quotes, perfect compounded trade. And that's how compounding can increase your returns. But it does increase the risk that you're going to get stopped out at different areas. Okay? All right. What else? Compounding, done. Moving stops before the breakout, done. Or just moving stops in general. Early invalidation, done. Moving stops, done. Multiple take profits, done. Moving TP, done. Let me see. Moving stops, take profit, done. Compounding, done. Early invalidation, done. How to manage emotions in trading, done. Advanced order types, done. Sorry, how to manage emotions. I'll talk about that in a sec. And I realized that I forgot to open the live questions, but I'll open that now. So, if you have a question. Question. If you have a question about this specific lesson, tell me. And we'll keep going. Okay. Managing emotions in a live trade. Remember what I said before. The simplest way to do a trade is entry, stop loss, take profit. If you do things like this, where you have multiple TPs, you have TP1 and you have TP2, that is now 2 decisions instead of 1. Okay? 1 decision. Enter, put your orders in, and do nothing else. This is 2 decisions. That is 2 opportunities for something to go wrong. That is 2 times where you can fuck it up. That's 2 mistakes that could be made. That's also longer that you spend in the trade as you're waiting for the second one to hit. And of course it increases complexity. If you go all the way then to this kind of shit, so many, like, what did I just cover there? I covered moving, so your original entry, that's 1 decision. Moving the stop loss up, that's 2 decisions. Breakout, adding to the trade, compounding the first time, that's 3 decisions. Moving the stop loss up again, that's 4 decisions. Adding the next one, that's 5 decisions. And then of course the exiting. So you have more decisions that are getting made. Plus, you're spending more time in the trade thinking about it. Meaning, and it's not like, obviously this trade, right, would have still been open until here. So if you're taking just the time of entry to the time of closing, it's the same amount of time. But in this trade, where you compound, you're watching this shit happen. Like, you're watching price dump towards your stop loss. Your total stop. That's going to absolutely test your emotions, test your psychology. Because over here, you're like, oh, my stop's fucking chilling. But here, you're like, shit, I'm literally dollars away from getting stopped out. So how do you manage those emotions? Testing. You have to have tested all this shit very thoroughly so you can trust it. You have to understand, I know that based on my testing, based on my back testing, based on my data, that moving the stops to here is the safest place, that if it goes below, it probably means a trend shift. Right? So you test it, you test it, you test it. Because before you have results live, before you've made millions of dollars and had multiple profitable years and many, many profitable months, you don't know if this stuff works. You can see me show it and it looks great in a lesson, but you haven't seen it live yourself. You haven't experienced those emotions live yourself. So the only way you're going to get to do that is through experience. So start small. Don't start off by trying to compound. I know everyone here is going to want to go fucking compound trades. Wow, massive gains. Yeah, sure. Don't think about the returns. Think about the risk. So start off small. Move your stops in line with market structure. Right? Like the simplest one of all, if you're just taking that first trade and you have that original entry, okay, which was over there, and your original stop was down there based on the 1 hour chart invalidation, and your target's all the way up here, and then you see the breakout. Just first of all, when it breaks out and you get that candle close and the bands go green, just move your stop up. Just do that. Right? And go and test that. How does it work if I just move my stop up? Forget all the other stuff. And then incrementally over time, set yourself tasks to try multiple take profits, to try compounding once. Don't go in and compound 3 or 4 times right away. Challenge yourself to do little by little. Growth is uncomfortable. I talked about this when? On the latest purple belt lesson, which is live now. Growth is uncomfortable. It's supposed to be uncomfortable. But the discomfort should be coming from the fact that you are pushing beyond your previous mental boundaries. The discomfort should not come from not knowing what you're doing. There's 2 different types of discomfort. It's very uncomfortable to be in a trade when you don't know why you're in the trade. So I get this question a lot. Michael, before I joined the real world, I bought like a Dogecoin and I bought Shiba and I bought these coins last cycle because, I was in the hype and someone told me, or Elon Musk was tweeting, and I've been holding it for 3 years and it's down a lot. What should I do? Get out immediately. As soon as you are aware, right? As soon as you realize I'm in this trade and I don't know why, it doesn't matter if it's up or down or sideways. Get out of it because it's just mental stress. It's discomfort. It's not the good type. If you're in a trade and you don't know what you're doing, you don't know why your stop is where it is, you don't know why you entered there, you don't know why your take profit is there, don't be in that trade. That's bad trading. And it's bad discomfort. Good discomfort is I'm going to do something I've never done before, but following rules. I've never moved my stop before, so I'm going to challenge myself this week that when I get a trigger, like a break of structure, and the market structure moves up, I'm going to move my stop. I'm going to journal it, take notes, and I'm going to get used to that feeling of moving the stop when the market tells me. Moving your stops is not a good idea by itself. Don't just move your stop because, oh, well, maybe it's going to lose and don't want to lose. No, only when you see something like this. Breakout, okay, cool. Impulse breakout, candles go green. We now have a trend forming. I'm going to move my stop up because the market's telling me it's going up and it shouldn't go back down. Then challenge yourself to compound a trade. Challenge yourself to use multiple take profits. Challenge yourself to have an early invalidation. All these kind of things. All right. And I did advanced order types. I did chase limit order, done that. Did conditional stop, done that. Limit orders. This is actually the first one I should have done. This is not an advanced order type. This is actually very basic. But when you use the whatever exchange you're using and you enter a trade, you will have a TP and an SL. So on the exchange itself, which I don't know if I can see it over here. Right, so let's just say you enter... Fucking hell, man. Where are we here? Let's just say you enter there. It doesn't let me do it. Wait, demo trading. I thought this was demo trading. Fucking hell. Man. Anyway. So, you guys know this anyway, right? If you're a blue belt at least. When you enter the trade, you have your entry, and then on the exchange it says this. It says TPSL, right? And so probably what you do and what you have been doing, is you put in your entry, and you put in whatever, 60,000. You put in your TPSL, and you put that in as 62,000 and 59,000, right? And then you click enter, and they all go on at the same time together. Your stop loss gets placed, your entry happens, and your TP gets placed. Now, those are market orders by default. So as soon as you're in that trade, there's something you can do right away to improve your expectancy, which is change your take profit to a limit order immediately, not your stop loss. Because when you enter, let's assume you're using market orders, right? Your entry is going to be 0.055% immediately, right? Let me reduce this size. Okay, so when you enter, that's how much you pay if it's a market order. Your stop loss, if it triggers, will be also that. As the exchange sets it, if you use a take profit order, that will also be this. It's a very simple thing you can do is just right away, as soon as that trade enters, cancel the TP, or just don't use it at all, but you'll figure that out, right? Cancel the TP, replace it with a sell limit order, reduce only, for the size of your trade. So if you opened a 1 BTC long, what the fuck? If you opened a 1 BTC long, man, what is this thing doing? Oh my god. Order. So if you had a 1 BTC long, you cancel the TP and you replace it with a sell limit order for 1 BTC with reduce only. That will then, if your take profit hits, that will then charge you 0.02% for that TP. And that right away is going to save you some money. That's going to give you more profit on your trade. It's going to take less fees, and you will right away improve your expectancy ever so much. And it seems like nothing, but trading is all about those minuscule, right, millimeters and inches. That's what matters in the markets, especially when it comes to things like fees. Now you might say, oh, well, why don't I do the same for my stop loss? Very risky. Because a limit order, there is such thing as a stop limit, but a stop limit requires the market to go through your stop and then back into it. Because when it goes through the stop, it triggers the sell order, but it does not close it. It has to then come back into it. That's how a limit order fills. A limit order can only fill when price moves into it. And so you run the risk of it going through your stop, triggering it, and then going on down. And then you lose 2R, 3R, 4R, 5R, you get liquidated. Boom, dead. And that can happen. Most times, it'll do this, and you'll get out, and you'll use your 0.02, but it's very risky, because that time, it only takes one of these to wipe out all the other ones. So don't fuck around with your stops. If you're wrong, just get out of the trade. Then, obviously, if you're doing anything other than scalping, you can also enter using a limit order. That could be a limit chase, even for day trading. Or if it's swing trades, limit order. You can wait 5 minutes for it to come back and fill your order, right? It's not that hard. Or again, limit chase. That will reduce your entry to 0.02, and that itself will take this whole thing, and let me break this down just in terms of how much it actually matters. Especially, like, you day traders know this, how much fees really impact things. But you could have it with limit order at entry, limit order at take profit. You could reduce the whole thing. Like, let's say your position size is 50,000, right? So this trade, what am I doing? Let me get out of this. Your entry is 60,000. So your entry would be, let me get this fucking thing. Okay. I'll do it like this. If your entry was 60k exactly, your fee would be 60,000 times 0.055%. $33. 33, okay? Your exit, your stop loss, if it hits, would be 59,000 times 0.055%. It would be, wait a minute, 59 times 0.055%. 32.45. And your take profit would be 62. 34.1. All right. And this is, remember, this would be a, what, 60,000 to 59,000. You're doing like, if you're doing 1 BTC. So that's like, you're 1,000 risk, but you also have 33 and 32. So you've got an extra $60 or $65 on top of 1,000, which is 1,065, which you're talking about adding on 6 or 7% to your total risk. That's not nothing. That adds up. If you use the limit orders, then your entry immediately would drop to 60 times 0.02%, $12. Your take profit, if it goes there, would cost you 62 times 0.02%, would only cost you $12.40, 12.4. And of course, you leave your stop loss as it is. You're just going to take that. Just take that hit. Don't get that advanced yet. Just stick with it, right? So on a winning trade, your fees drop from 34 plus 33, 67.1. Your fees drop from 67.1 down to 12.24, 24.2. And again, the total risk of this trade would have been, originally at least, would have been 1,000. So you're talking about dropping from 6.7% of your trade being fees to 2.4 of your original risk. That's significant. That's significant. All right, that's it. GM. Now, I'll do some more questions. Give me a second, and I'll do the questions in one moment. Get your questions in as quick as you can, and then we'll do it. All right, GM. Questions. Let me close this. And there we go. Listen to price. What's price telling you? Fuck you. Hilarious. All right. So. Here we go. Lots of questions. Well, Ethan, as you explained compounding, is compounding and adding size the same? Already covered. Yeah. And do you have to open just another long with the new stop loss? Because moving the stop loss above your entry price is price moving higher and higher is showing your swing trade, or can you just move the stop loss higher and higher even above your entry? If you're just using a stop loss order, so if your stop loss is set for the trade and you open more, so if you open 1 Bitcoin and you put a stop loss in, then you add 1 Bitcoin again and you move the stop loss up, it will be the stop loss for the entire trade. Asher, GM. I'm doing the alternative submission for Blue Belt, started live trading and use backtest system. My exit rule is on a signal that sometimes gets hit before the trade is profitable. If I exit that signal based on trade managed, got lost, be outside 10% standard deviation. Should stay in the trade. No, it's fine. The deviation of risk is only on the upside. Sorry about that. It's Bitcoin, I think. So your goal is to not deviate below it more, right? It's important. Your goal is to not deviate, above it. If you're trying to risk $1, your goal is to not lose more than 110. If your system gives you an early reason to exit, that means you lose 70 cents, that's fine. That's good risk management. X-Park, GM, got a bonus Eiffel Tower. Well, I guess that's a compliment for the workshop. Systems in different markets. Sorry, how do you manage systems when the volatility of coins change? Example, Bitcoin is much less volatile now compared to last bull market. Doesn't make a difference. In practice, it doesn't make a difference. Your system should be based on... Your system's not based on volatility. Your system's based on market structure, for example. So if Bitcoin has less volatility between swing high to swing high, as it did before, that's fine. The swing high to swing high is still the same thing. So wherever you place your stops remains. Question 2. How do you decide your partial take profit percentage? It depends. I rarely do it anything complex. I normally just close half the trade. If I want to leave some open, I just normally close half the trade. Or like I did on the live stream yesterday, that was more of a reduction of risk. So I took some off so I could move my stop. That was just to make sure that if it went to the new stop, I wouldn't lose more than my original 1 hour. Question 3. For squeeze, are you able to identify based on probably the start of the squeeze in the OI charts? Nope. Forget short squeezes. Look, there's no such thing as just a short squeeze. It's something that we say, right? And there are times, especially in downtrends, right? In downtrends, when the market is moving in one direction, everything here that you see, like all of these moves on BTC, not these ones, what the fuck am I? Okay. All of these bounces are essentially short squeezes because they're counter trend, the trend is down, and it squeezes up, and it squeezes up, and then it makes new lows, and it squeezes up, and it makes new lows, and it squeezes up, and makes new lows. They're all squeezes, right? But identifying a short squeeze is not important. All you have to identify is an uptrend. The short squeeze is more about how fast it happens and whether there's a lot of liquidations and open interest declines and stuff. But again, if you're trying to capture longs, just trade it based on the earliest point you can identify an uptrend, have your invalidation, and then trade it. That's all that matters. And the reason I say this is because you'll hear me say a lot, this is just a short squeeze. That's just me saying it. Like, I know this based on experience, but it's also not, it's never just a short squeeze. It's not like it's only shorts getting squeezed. There's also bullish people buying, right? And everything in between. But what you're saying that what I'm saying when I say that is, if I say it's a short squeeze, that's me saying that this, at least in my opinion, is not going to be a new uptrend. It's probably just going to go up enough to squeeze out shorts, and it's a counter trend retracement before we continue in the previous direction. That's the difference. A short squeeze will be the counter trend bounce. A short squeeze will also be the start of the new trend. Right? It's not like not every short squeeze leads to new lows. The very last short squeeze is actually the start of the uptrend. Right? You can see this here. So all the way along here, as we went down, short squeezes, short squeezes, short squeezes. Then this was also a short squeeze. This is a big short squeeze. It happened to also be the bottom, and the market continued higher. So it's not like every short squeeze will fail. It's just a way of understanding. If the market's going up due to bullish buying and spot accumulation and, excess of real demand, that's more likely to continue going up. If the market's only going up because people got too short into a low and it's pushing them towards their invalidation, their take profit, their stop loss, or their liquidation price, that's less likely to continue because it's not a sign of genuine demand. Understand? Unez, GM. So they have two styles. One has a lower win rate and a bigger RR. I think he should focus more on how to manage his losses and look for ways to cut them early with invalidations and let his big wins run without taking partials. Speaking from my experience, I sometimes tend to take partials on my big wins, like plus 8 RR. That affects my EV as I don't cut my losses early and then I lose them if they lose. Let them lose. So I end up with, let's say, a random example of 4 losing streaks, and when a big win comes, I take partials and then I break even. That's not optimal, right? Yeah. What psychology should this type of trader adapt compared to another style of trader's high win rate system where he doesn't cut his losses? Find it hard to stack both of them and switch between these styles. What's your opinion of this? Yes. What you're describing there is trading your P&L. So, you have 4 losses in a row, then you get a big winner, but because the memory of the 4 losses is in your head, and in your brain you're down 4R, and you want to make back that money, you can be tempted to take profit at 4R profit. Even though your system says, don't exit yet, you can be like, no, but now I can take profit on this one, and then I'm back to flat. And being back to flat after being down -4 feels good. But it's not. Because if that original trade was not invalidated, and it kept going to 8, you've missed out. And you need those winners to make up for the losers. So all you have to do is create rules and stick to them. That's all it is. As long as when you make the decision, just try and be present and conscious and think, okay, I'm about to take profit on this winning trade. Am I doing it because my system says to exit? Or am I doing it because I want to make back a certain amount of money? As long as you're exiting because of your system, you're doing it right. Game killer. So if you'd lose the third trade you just showed us while compounding, you still end in profit, right? 12R minus 1R, if I'm right. No, you don't get the 12R. It only gets the 12R if it goes all the way to the stop, to take profit. If it goes back and stops you out, you lose 1R. That's the risk of compounding. Now, you can also, at that point, and what I did in that trade, by the time I added the third, and I even added a fourth and a fifth, when I added those extra trades, I didn't keep adding my 1R of risk. I moved my stops to a point where if it stopped me out, I would make 2 or 3R. Right? You don't have to keep adding more risk to make it always 1R. You can also say, okay, I'm compounding it now more aggressively, but if it stops me out, it will stop me out in profit. That's fine. That means then instead of winning 12, you might win 3. It's still a loss of unrealized gains, but it's locking in some profit. Danny, is the live going to be uploaded? Every single live I ever do and ever have done is always uploaded. Maybe I should pin that in every fucking channel. Yes. It'll be up for 24 hours. Weekend workshops up for the weekend. Booster, GM. Did you move your stop on yesterday's day trade once it turned into a swing? Yes. The stop loss on the day trades into the swing is here. Where was the original? Well, let me go into the 15-minute. So, sorry, I went to 5-minute. Originally, when I went off the stream, when I left you guys, the stop loss was here, right? At the New York Open, 130. Yeah. And so that was the stop loss originally. And then all the way down, and then I took profit down at 53.3. My stop loss, I believe, is down here at 50. Sorry, I have to check my exchange. It's above this retest, so I'm pretty sure it is here at 55.5, around that area. Why? Well, when you zoom out to this level, in my experience, if this is going to continue lower, it won't go any higher than these. See where this continued selling happened? Right up to this wick. We won't go there. I don't think we'll even go above this wick here, based on my system. And I think that all of this is going to be like, chopping around in here, and then I think we go lower. And if it goes to here, I would view that as being much more likely, right? If we went to that level, I would view that as actually being much more likely that we're going to retrace the whole thing and go for the stops. It shouldn't go there. You can also take it like this. I don't really use fibs, but you can use fibs like this, top to bottom, right? Top to bottom, and you can look at the retracement. This is around the 50%, which is where it should stop really. It might go to the 0.618, which I don't have on this, but you can add it on if you want. It might go to the 0.618. Maybe it could go to 55.3. And it's funny how that actually lines up with where I would have my max invalidation anyway. Sometimes just eyeballing the chart, you can sort of see these things. And it definitely shouldn't go 75%, right? So if you want to do that, you say, all right, well, if it goes to 75%, what does that mean? That means probably we're seeing a trend shift. 75% retracement of the previous trend leg might mean we go into a ranging environment. So anyway. Mahalo, GM. When I make a system, I've got profitable win rate, positive EV, and I know how I know after sometimes the system is not profitable yet. It's possible coin can change moving. Yeah, I covered that on a Blue Belt stream last week. Not last week, 2 or 3 weeks ago. Which one was it, guys? Was it fucking this one? Here, this one. How can I know when my system has stopped being profitable? Cover it in that stream. Look forward. When using multiple take profits, would you recommend keeping the TP rules on the same time frame? Would it be okay, for example, to have a 50% TP at RS Extreme instead of 5, and the rest of the trade TPC RS then 715? Test it? Yeah, test it. Is it not a good idea to manage a trade on multiple different time frames? I do manage my trades on multiple time frames, so each to their own. I would say try both. Armando, when you add the position, are you actually opening a second or third trade or adding to initial one? How do you do it actually? So on Bybit, but I think on most exchanges, you open another trade. Like you literally have to go long more money. You have to open a bigger trade, right? You add another order. What happens on most exchanges is if you were 1 BTC long and you add 1 BTC, it stays as one trade, it just becomes 2 BTC. And your average entry will move up. Daniel, GM, do I need to increase my leverage? Nope. Leverage is completely irrelevant to this discussion. The only time you would have to increase leverage is if you have less collateral. So you do have to be aware of it, obviously. But no, position size is all that matters. If you have a bigger position size and you don't add any more money to your account, it will use more leverage because you have a bigger position size. But if you're moving your stop loss, it doesn't matter. If your risk is still the same and your liquidation price is well away from your stop loss, so it's not going to get liquidated, you're totally fine. Don't forget to account for fees though. When you compound a trade, you're making the trade bigger. A bigger trade when it gets stopped out will have higher fees. So make sure you calculate the new fee level. Daniel, do I need to increase my leverage? Sorry, don't know. Mort, regarding calculating the size when compounding, if the first trade will have stop loss and profit, it means you actually have more room to risk, right? For example, the first trade would have stop loss at 10% profit, you have about 10% more room to add size the next one. Yes, if the new stop loss would have it in profit, yes. Usually, in my experience, that extra 10%, that accounts for the fees. So I'm able to keep the position size to be exactly 1 hour or whatever. But if it gets stopped out, that will account for the fees. Dasher, GM. How can we do it all in exchange? I mean, moving stop loss, compounding, etc. Depends on your exchange, but it's very easy. Just start off doing it with low stakes, like dollar amounts, and just play around with it. The only order types you need for everything I said today was limit order, limit chase order, conditional stop. My Infinity GM. And if you have a question, like you on your exchange, ask in the chats, right? Say like I'm using fucking whatever, Binance. How do you do it in Binance? Because I don't use Binance, I use Bybit, but whatever. My Infinity. Why is adding more size to a trade considered a good strategy? Wouldn't it be better to start with the full amount if you're confident the trade will succeed? You're not. Why would you be confident? Adding size mid-trade seems to increase complexity and risk. If the setup is strong, why not just commit fully from the start? No, because you risk management, bro. So if I'm risking 1 hour at the beginning, so first of all, I mean, you're not. So let me explain this. Over here. Right, so over here, I go long, and my stop is here, and the maximum I can risk is $1,000 from that example, right? I can't say, oh, well, I'm confident it's going to go here, so why not I just risk 3,000? Because 3,000 is 3 hour. I don't risk 3 hour in a trade, I risk 1 hour. But if it then moves in my favor, and then I'm getting more confident that it will go higher, because there's now a new structure level, right? It's moved up. I can then add to it and keep the 1 hour risk at the beginning. I think the thing you're misunderstanding is, commit fully. I am fully committed at the start. I'm fully committed to 1 hour, which is all you can risk on a trade, right? Whatever amount 1 hour is to you. That's all you can risk on the trade. You already say, what is my maximum allowable risk on this trade? You put that on at the start. And if it goes in your favor and you can move that up and add to it and keep that maximum risk fixed, then you can add size. Sean, GM. You say null point 55. What does null point mean? What? What's null point? I don't know. Where does that? Is that? I don't know. Tell me in the chats. Anyone else confused about null point? I'm definitely fucking confused. Null point 55? No idea. Null point? Anyone? 0.5? Okay, so you're talking about this? 0.055. When I was doing this? 0.055%. That's how much the fee costs on Bybit. So every exchange is different, but everyone should know in Blue Belt, you should know the fees for your exchange. So Bybit's trading fee structure for a new account with no VIP, none of that stuff, is here, taker, which is a maker, which is a market order, 0.055%. That's why I said 0.055 and 0.02. Your exchange will be different, and of course, as you go up in size, your fees will drop as well, but obviously I have to base it off the lower end rate, and you can check that for your own exchange. Alright, GM everyone. Thanks for joining. Hope you enjoyed it. GM. And Purple Belts, we're going live for the Purple Path exclusive stream in about 30 minutes. There may be some follow-on questions there that we can talk about. And that's it. GM, this will be up for 24 hours till the end of Sunday. Thanks for joining everyone. GM. Talk soon.